So, Texas Instruments is what, a 96-year-old hardware company?
Yeah, almost a century old.
Right. Selling physical metal, plastic, and, silicon. So, this is the big question. How exactly does a legacy industrial giant just post a staggering 37% jump in operating profit?
While simultaneously keeping 209 days of unsold inventory just sitting dormant on its warehouse shelves.
Exactly. I mean, it makes no sense. In almost any other sector, holding that much inventory while scaling profit that aggressively is, well, mathematically impossible.
Right. It usually signals a massive misallocation of capital, like you're building stuff nobody wants.
Yeah, a huge red flag.
But when you look at the architecture of the semiconductor market right now, that paradox is actually the blueprint for a highly defensive, incredibly lucrative moat.
And that is exactly what we're getting into today. Welcome to the Deep Dive. Today we are tearing into the first quarter 2026 earnings call for Texas Instruments, ticker symbol TXN.
It's a fascinating one.
It really is. We've got the transcripts, the management commentary, the supplementary financial data, and our goal here is straightforward. Extract the actionable reality from all the Wall Street rhetoric.
Because there's always a lot of rhetoric.
Right, absolutely. But whether you hold TXN in your portfolio or, you're considering a position, or you just recognize that Texas Instruments is sort of the ultimate bellwether for the global economy, you really need to understand what these numbers are signaling.
Yeah, you have to look past the top line noise.
Right. Because the data we are looking at today poses this massive question. Are these blowout Q1 numbers just a temporary inventory distortion? Or is this the definitive starting gun for a sustained multi-year supercycle in the chip sector?
And to answer that, we really have to isolate the underlying mechanics of their revenue growth because, looking at the absolute top of the income statement, the numbers are incredibly aggressive.
It's shocking, honestly.
Yeah. For the first quarter of 2026, Texas Instruments reported top-line revenue of $4.8 billion.
$4.8 billion. And that figure didn't just beat consensus estimates, right? It comfortably cleared the absolute highest end of their own management guidance range.
Precisely. So we're looking at a 9% sequential increase from the fourth quarter of 2025 and a massive 19% year-over-year jump compared to Q1 of last year.
19% year-over-year growth for a company valued well into the 12 figures.
Right. It's huge.
Let's be real. This isn't a pre-revenue software startup just turning on a new subscription tier. This is a physical supply chain moving millions of physical components.
Exactly. It takes real energy and materials.
Right. But before we get to the physical side, let's look at the bottom line. So EPS earnings per share came in at $1.68. But looking at the data, it seems we need to strip out a 5-cent discrete tax benefit.
Yeah, that's an important detail. For anyone building a long-term model, you back out that specific tax benefit because it is a non-recurring accounting event. It's just a one-off.
Got it. So you can't rely on it for the future.
Right. That leaves you with an operational baseline EPS of $1.63. Which, frankly, is still a tremendous beat.
It really is.
But, the EPS isn't even the most vital metric here. The real story of this quarter is buried in the margin expansion.
Yeah, let's talk about that. Gross profit margins expanded by 210 basis points, landing at 58%.
58% on hardware.
Right.
Yeah.
And that gross margin expansion is what fueled that insane 37% surge in operating profit, pushing it to $1.8 billion.
Which is just wild leverage.
It is. Think about that. A 19% increase in top-line sales translated into a 37% increase in operational profit. The profit grew nearly twice as fast as the revenue.
Yeah, it's exponential.
So I want to test a hypothesis on why this is happening.
Yeah.
In software, we talk about zero marginal cost, like the 1,000th copy of an app costs nothing to make.
Right.
But in hardware, you have massive fixed costs. So is this essentially the dynamic of like a hydroelectric dam?
A dam. Okay, I like where this is going.
Yeah, like you spend billions building the concrete structure right, and the turbines. But once it's operational and the water is flowing, the cost to generate the next megawatt of power is practically zero. So it all just flows straight to the bottom line.
The mechanics are virtually identical. That is a great way to put it. This is the pure definition of operational leverage in semiconductor fabrication.
Okay, break it down for us.
So over the last several years, Texas Instruments has poured billions of dollars into their capital expenditures, specifically building out their massive 300 millimeter wafer fabrication plants.
The famous mega fabs.
Exactly. Those fabs are the hydroelectric dams in your analogy.
Yeah.
The depreciation and the fixed operating costs of running a clean room of that magnitude, they're staggering.
And they have to pay those costs no matter what.
Right. They hit the income statement whether the fab is running at 40% utilization or 90% utilization. You still have to pay to keep the lights on and the air perfectly clean.
So when demand was softer last year, those fixed costs were basically a heavy anchor dragging down the margins.
Exactly. The cost of the massive factory was spread across fewer chips. But now, with revenue jumping 19%, the volume of chips running through those existing facilities is just surging.
So the fixed costs stay the same.
Right. The fixed costs remain static, meaning every incremental chip they produce and sell carries a significantly higher gross margin. They are fully absorbing their fixed costs.
Ah, I see.
And because a 300 millimeter wafer yields roughly 2.25 times more chips than the older 200 millimeter standard, the unit economics just accelerate violently to the upside once those utilization rates climb.
That makes total sense. That is how you get a 210 basis point expansion in gross margin on physical metal and plastic.
Exactly. It's pure operational leverage at scale.
It's a phenomenal demonstration of capital scale.
Oh.
But this brings us to what they are actually fabricating on those wafers.
Right. What are they actually selling?
Because the sources divide their revenue into two primary segments.
Mm-hmm.
You've got analog revenue, which makes up the bulk of their business, and that grew an impressive 22% year over year.
A huge jump.
And then embedded processing grew 12%.
Right. And to understand the market dynamics, we really have to look at what those segments physically do in the wild.
Yeah, translate the engineering speak for us.
So the analog chips are essentially the critical interface between the messy, unpredictable physical world and the precise digital realm.
The physical world meaning?
Meaning variables that are continuous. So temperature, pressure, acoustic signals, and most importantly for this quarter, power distribution.
Got it. So anything that isn't just ones and zeros.
Exactly. And then on the other side, you have the embedded processing segment.
What do those do?
Those are the local brains. They're the microcontrollers that sit at the edge of the network. They take the data provided by the analog sensors, they run the logic, and they dictate the mechanical response.
Give me an example of how they work together.
Okay, so if an analog sensor detects a thermal spike in a server rack, the embedded processor is the chip that instantly decides to, increase the RPM of the cooling fans.
Oh, I see. Analog senses the heat, embedded turns on the fan.
Exactly. So the fact that analog is growing at 22% and embedded at 12%, it gives us our first real clue about the nature of this recovery.
So?
It tells us the recovery is hardware intensive, sensor heavy, and deeply, deeply rooted in power management.
Which perfectly sets up the demand side of the equation. Because look, an earnings beat driven by operational leverage only matters if the end market demand is sustainable.
Right. Otherwise, it's just a blip.
Exactly. If this demand is just a mirage, that leverage violently reverses, the dam dries up. So we need to look under the hood at exactly who is buying these chips.
And looking at the sector breakdown, the numbers are extreme.
Very extreme. Industrial revenue exploded, up more than 30% year over year.
Yeah, that number took the broader market completely by surprise. Nobody modeled for 30%.
It certainly caught my attention. But the data center revenue is the one that really jumps off the page. Data center skyrocketed, up roughly 90% year over year.
90%. Just staggering.
Meanwhile, automotive was essentially flat, sequentially, though holding on to mid-single-digit growth year over year. And personal electronics, so smartphones, laptops, consumer gear was totally flat.
Yeah, consumer tech is just treading water right now. What you were seeing in that sector breakdown is what management explicitly referred to on the call as the broad market waking up from hibernation.
Okay, I am going to challenge that narrative right out of the gate.
Okay, let's hear it.
Specifically on the industrial side, a 30% jump in industrial chip orders in a single quarter does not look like an organic awakening to me.
What does it look like to you?
It looks like the bullwhip effect in action. I mean, we saw this exact phenomenon in the aftermath of 2020. Supply chains get slightly constrained, purchasing managers panic, and a factory that actually needs 10,000 chips suddenly places orders for 30,000 just to guarantee they get allocation.
Right, the toilet paper hoarding dynamic.
Yes. They double order, they hoard.
Right.
So is this 30% spike just industrial customers terrified of a shortage, artificially inflating the demand curve?
It is the most critical question to ask when evaluating these cyclical hardware stocks. And honestly, the analysts relentlessly pushed management on that exact point during the Q&A.
Good, because if this is hoarding, the stock is a trap.
Exactly. If it's fake demand, Q3 is going to be a disaster. But management deployed a very specific historical data point to refute the hoarding hypothesis.
Okay, what's the data point?
Even with this massive 30% year-over-year explosion in Q1, Texas Instruments' overall industrial revenue is still 15% below its 2022 peak.
Wait, really? Let me make sure I have that timeline right. Even after surging 30%, the absolute volume of industrial sales hasn't even reclaimed the high watermark from 4 years ago.
That is correct. And that context completely changes the diagnosis of the market. Consider the secular tailwinds in the industrial sector. Over the long term, the semiconductor content per device in industrial applications only goes in one direction.
Up, because everything is getting smarter.
Exactly, up. We are putting analog power management chips and microcontrollers into HVAC systems, factory robotics, smart grid infrastructure, even standard power tools that historically had zero silicon content.
Right, like a drill that now connects to Bluetooth for some reason.
Exactly. Given that secular growth trend, the mathematical peak of 2026 should, by definition, be significantly higher than the peak of 2022.
So the fact that we are still sitting 15% below a 4-year-old high means we aren't anywhere near the territory of overordering or inventory hoarding.
Precisely. It strongly suggests that this 30% jump is simply a structural recovery.
A normalization.
Yes. For the last 2 years, industrial customers have been aggressively burning through the excess inventory they built up back in 2022. They were in hibernation, operating off their existing stockpiles.
And now those stockpiles are finally depleted.
Exactly. They have to return to the market just to meet their baseline production needs. This isn't a panic buying surge. This is the normalization of the industrial supply chain.
Okay, so the cargo ship was stuck in the mud, and it's finally broken free and is just getting back to cruising speed. That actually makes a lot of sense for the industrial side.
Yeah, the data backs it up.
But let's look at the 90% growth in data center revenue, because this one is fascinating to me. For the last 18 months, the entire semiconductor narrative has been monopolized by one thing.
AI.
AI. And specifically, the ultra-expensive, cutting-edge GPUs that train those models. But Texas Instruments doesn't make GPUs.
No, they don't.
And they don't make high-bandwidth memory.
Yeah.
So what exactly are they selling into the data center that warrants a 90% growth rate?
The answer lies in the actual physical reality of those AI workloads. The single biggest bottleneck in modern data centers right now isn't compute capability, it is power density.
Power density. Explain that in this context.
So a standard legacy server rack, the kind running normal websites or databases, might draw 5 to 10 kilowatts of power.
Okay.
An AI server rack packed with advanced GPUs can easily pull 40 to 100 kilowatts of power.
It is a massive jump, 10 times the power.
Yes. And when you push that much electricity into that small a physical footprint, the electrical engineering challenges become monumental. You have severe what they call I²R losses in power transmission.
Meaning what exactly?
Meaning massive amounts of energy are lost as heat if the voltage isn't managed perfectly.
Right, because you can't just run 100 kilowatts straight from the local grid into a delicate piece of silicon.
Exactly. The server rack itself might be pulling power at 48 volts from the facility, but the actual GPU itself operates at under 1 volt.
Oh, wow. So it has to be stepped down.
Yes, drastically. And it gets harder. That GPU's power demand isn't static. It has massive instantaneous transient spikes where it suddenly demands hundreds of amps in a single microsecond to execute a complex calculation.
And if the power supply can't keep up?
If the voltage drops for even a fraction of a millisecond, the GPU crashes. And if the voltage spikes, the GPU literally fries. You destroy a $30,000 chip.
Oh, man. And that is where the analog power management chips come in.
That is Texas Instruments' absolute bread and butter. They provide the highly specialized analog power ICs, the voltage regulators, the power switches, the thermal management sensors that literally surround the GPU on the motherboard.
So they're the bodyguards.
Yes, they step the voltage down efficiently, they respond to those transient power spikes in real time, and they ensure the processor doesn't melt. As data centers transition to these incredibly power-dense AI architectures, the ratio of analog power management chips required per server rack grows exponentially.
So they are essentially selling the foundational infrastructure for the AI gold rush.
Precisely.
I mean, they aren't designing the digital brains doing the heavy lifting. They are engineering the cardiovascular system that keeps those brains alive and stops the data center from catching fire.
And that cardiovascular system is non-negotiable. You cannot deploy an AI cluster without state-of-the-art power management. It just won't work.
Which explains why a legacy analog company is capturing 90% year-over-year growth in the data center segment, alongside the high-profile AI players.
Exactly. They're riding the exact same wave, just a different part of the wave.
And this focus on infrastructure and connectivity also perfectly explains the major strategic move they announced alongside these earnings.
Ah, yes, the Silicon Labs acquisition.
Right. Texas Instruments is acquiring Silicon Labs, with the deal expected to close in the first half of 2027. The stated goal in the sources is to boost their embedded wireless connectivity.
Yes.
But I have to ask, TI has one of the largest R&D budgets in the world. They have thousands of engineers. Why spend the capital to acquire an entirely separate company like Silicon Labs instead of just building wireless connectivity in-house?
Because radio frequency, or RF engineering, is notoriously difficult. It is often described in the industry as a dark art.
A dark art?
Seriously. Designing an embedded processor that performs basic logic is one thing. Integrating ultra-low power wireless protocols, whether that is advanced Bluetooth, Wi-Fi, Zigbee Thread, or the new Matter protocol, directly onto the same piece of silicon without introducing massive signal interference.
Oh, right, because radio waves cause interference.
Exactly. Doing all that on one chip is an incredibly complex challenge.
And Silicon Labs already solved it.
Silicon Labs has spent decades perfecting the IP for secure, low-power, multi-protocol wireless connectivity. And they did it specifically for the Internet of Things and industrial edge devices.
So it's plug and play for TI's existing customers.
Exactly. By acquiring them, TI isn't just buying a new product line. They are buying a critical capability to marry with their existing microcontroller dominance.
The integration makes total sense when you look at that industrial awakening we just talked about. I mean, think about it. The factory in the future isn't just a robotic arm operating in isolation.
Right.
It is a robotic arm packed with TI analog sensors, monitoring its own vibration and temperature, feeding that data to a TI embedded processor. And now, that processor uses Silicon Labs wireless IP to transmit that data in real time to the factory floor network.
Without needing a hardwired Ethernet connection.
Exactly. It creates a closed-loop ecosystem. Texas Instruments can walk into a major industrial automation customer and say, we can supply the power management, the physical sensing, the local edge processing, and the secure wireless transmission, all on a unified, heavily integrated platform.
It is a massive competitive advantage in capturing the next decade of industrial IoT growth. They own the whole edge.
Okay, so we have established a phenomenal Q1. We understand the secular drivers in industrial and the power density demands in the data center.
Yep, the fundamentals are strong.
But the market is forward-looking. This brings us to how management is forecasting the rest of the year. And this is where I start to see some fascinating contradictions.
Let's look at the Q2 guidance.
Right. The guidance numbers present a very specific scenario.
Yep.
Management is forecasting Q2 revenue between $5.0 billion and $5.4 billion.
Which is a solid bump.
Yeah, if we take the midpoint of that range, so $5.2 billion, that represents roughly an 8% sequential growth from Q1. And the transcripts specifically note that this is slightly above their normal historical seasonal trends for the second quarter.
Yes. And they are guiding Q2 EPS at $1.77 to $2.05. They also noted that their expected tax rate will normalize back to 13%, so we don't have the noise of that discrete tax benefit going forward.
So we've got sequential growth above seasonal norms, solid EPS projection. But then we hit the balance sheet data, and this is the paradox I brought up at the very beginning of the show.
The inventory.
Yes, the inventory. Texas Instruments is currently holding $4.7 billion in inventory. That translates to 209 days of inventory.
209 days.
Over half a year's worth of product sitting idle. To put this in perspective for you, if a smartphone manufacturer or a PC hardware company was holding 209 days of finished goods, Wall Street would completely panic.
Oh, the stock would plummet.
Right, because in consumer electronics, technology degrades rapidly. 6 months from now, a new standard comes out, the old inventory is obsolete, and you are forced to take massive multi-billion-dollar write-downs.
Nobody wants last year's phone.
Exactly. So why is Wall Street not punishing Texas Instruments for this massive stockpile?
Because of the inherent nature of analog components, you really have to divorce the concept of analog inventory from the concept of consumer tech inventory.
How so?
An analog power management IC designed to regulate the voltage in a commercial HVAC system,
Right.
or an embedded microcontroller built to run an automotive braking system, it does not follow Moore's law. It doesn't become obsolete in 6 months.
Right.
In many cases, it doesn't become obsolete in 10 years.
So the product life cycle is effectively permanent.
It is remarkably long. These are highly standardized catalog parts. They don't spoil. So holding $4.7 billion of this specific type of inventory carries very little write-down risk.
Okay, so it's not a liability.
Right. But more importantly, management views this inventory not just as safe, but as a strategic offensive weapon.
Wait, how does sitting on cash trapped in silicon act as an offensive weapon?
It is all about dominating lead times and guaranteeing supply chain security. Think back to the global chip shortage during COVID.
Oh, it was a nightmare.
Right. Industrial and automotive customers lost billions of dollars in revenue because they couldn't secure basic 50-cent analog chips to finish their products. They were quoted lead times of 52 weeks.
A whole year just to get a basic part.
Yeah, it caused immense trauma across the manufacturing sector.
Right. I remember seeing drone footage of just thousands of cars sitting half-finished in parking lots because they were waiting on a single microcontroller for the windshield wipers.
Exactly. Texas Instruments recognized that trauma by intentionally keeping their inventory levels historically high at over 200 days. They are making a very aggressive promise to the market.
Which is?
When an industrial customer's demand suddenly spikes and they need 100,000 power management chips next week, TI does not have to spin up a new factory run. They don't have to put the customer in a queue. They can literally pull the parts from the warehouse shelf and ship them immediately.
The guarantee supply when no one else can.
Yes. And that absolute reliability wins immense, deeply entrenched customer loyalty. Engineers will design Texas Instruments chips into their product blueprints specifically because they know TI has the balance sheet and the inventory strategy to guarantee availability.
So the inventory is actually a defensive moat against competitors who run a leaner just-in-time model?
Exactly. Just-in-time is great until it's not. TI is saying, we have it now.
It is fascinating. They are leveraging their balance sheet to solve their customers' supply chain anxiety.
Right.
And we see that same focus on supply chain security in their capital expenditure strategy, too.
Right, the new fabs.
Yeah, the sources highlight that they received $555 million in direct funding from the U.S. GPS Act.
That funding is specifically allocated for their new 300-millimeter wafer fabrication facility in Sherman, Texas.
And alongside that government funding, they are maintaining their own massive CapEx budget of $2 to $3 billion for the year. This ties directly into the geopolitics of semiconductors, doesn't it?
It absolutely does. The geopolitical risk premium assigned to the semiconductor supply chain over the last few years is unprecedented. Most of the world's advanced manufacturing and packaging happens in Southeast Asia.
Which is a huge bottleneck risk.
Massive. So Texas Instruments is aggressively spending to domesticate and control their own manufacturing footprint. Building these mega fabs in Texas provides another layer of security for their North American and European customers who are under pressure to de-risk their own supply chains from geopolitical flashpoints.
Buy from us. It's made right here in Texas.
Exactly.
So they are building domestic capacity, they have a massive inventory moat, and they are projecting above seasonal sequential growth for Q2. By all objective data points, the environment looks incredibly strong.
It really does.
But this is where I need you to reconcile something for me. I read the transcript of the management Q&A. Despite the blowout numbers, despite the GPS Act funding, despite the strong Q2 guidance, their tone regarding the second half of the year was shockingly cautious.
Yes, it was very muted.
They refused to spike the football. They sound like a driver hovering their foot over the brake pedal on a completely clear highway. Why the disconnect between the data and the tone?
The caution stems from institutional memory, specifically the trauma of 2025. Management repeatedly referenced the false start of the previous year.
A head fake.
Exactly, the head fake. In the first half of 2025, the industry saw a very similar pattern. Strong sequential growth, apparent normalization of inventory, and what looked like the beginning of a sustained cyclical recovery.
And then what happened?
In the second half of the year, the macro environment completely shifted. Interest rates remained punishing, inflation flared up in specific regions, and end market demand suddenly evaporated. The recovery completely stalled out.
So they have been burned by this exact setup before.
They have, and Texas Instruments management team is historically known for being incredibly pragmatic. They look at the current global macroeconomic picture, ongoing geopolitical tensions, unpredictable central bank policies, mixed consumer data in major economies, and they are refusing to underwrite a second-half supercycle until they see the purchase orders physically materialize.
Prove it first.
Right. They are providing strong guidance for Q2 because they have the visibility. They are refusing to guide aggressively for Q3 and Q4 because they refuse to base their strategy on optimism.
Which honestly forces us to make our own assessment. We have the underlying drivers, the industrial normalization, the AI power density demands. We have the strategic framework, the Silicon Labs acquisition, the massive inventory mode, the domestic fab build out, and we have management's cautious near-term tone. Synthesizing all of this, what is the definitive bottom line for Texas Instruments? Are we looking at a bearish, cautious hold or a bullish accumulation?
Looking at the structural reality of their operations, I take a distinctly bullish stance on the company coming out of this quarter.
Okay, bullish.
And my reasoning goes beyond just the immediate demand recovery. It comes down to how they have positioned their internal supply chain to capture maximum margin in either macroeconomic scenario.
Walk me through that. Why bullish when management is still worried about a second-half head fake?
Because TI has evolved into the ultimate supply chain shock absorber. The key detail in the sources isn't just the 300-millimeter fabs they are building. It is the fact that they have fully built out what they call Phase 3 capacity.
And what does that mean in practice?
Crucially, it means they are spending massive amounts of capital to move their assembly and testing operations entirely in-house.
Let's expand on that because the distinction between front-end fabrication and back-end assembly is often misunderstood by retail investors.
It is a vital distinction. So in the semiconductor life cycle, the front end is the fabrication. That's baking the intricate silicon circuits onto the 300-millimeter wafers in the giant clean rooms in Texas.
Right, the stuff that requires the bunny suits.
Exactly. The back end is assembly and testing. That's taking that massive silicon wafer, cutting it up into individual dies, securing those dies into the black plastic and metal packages that actually get soldered onto a circuit board, and running the final electrical test to ensure they work.
Historically, a lot of that back-end work was outsourced, right?
Yeah, exactly. Even companies that own their own front-end fabs would ship the finished wafers across the world to OSATs. Outsourced semiconductor assembly and test facilities. They are primarily located in Malaysia, Taiwan, and mainland China. But during the supply chain crisis, the OSATs became the primary bottleneck.
Oh, because they were backed up with everyone else's orders.
Yes. You could manufacture all the silicon you wanted in Texas, but if the packaging facility in Asia was shut down or overbooked, you couldn't ship a finished product.
So by aggressively moving assembly and testing in-house, they are removing that final variable outside of their control.
They are completely internalizing their own destiny. They have the internal front-end capacity, the internal back-end packaging, and 209 days of inventory.
It's end-to-end control.
Exactly.
Yeah.
So if the bullish scenario plays out, and this broad market awakening accelerates into the second half of the year, TI is one of the only semiconductor companies on Earth that can immediately capture that surging demand without hitting an outsourced manufacturing bottleneck.
And if the bearish scenario plays out, like if we get another 2025 head fake and demand collapses in Q3.
They are structurally insulated against the downside as well. They simply dial back the utilization rates on the fabs and let the inventory sit. Because like we discussed, the chips don't go obsolete. A demand collapse doesn't force a catastrophic write-down. It just delays the revenue realization.
Wow.
They have engineered a business model that is highly asymmetric. Massive upside capture with heavily protected downside risk.
And the ultimate proof of that asymmetric model is the cash generation. There is a very specific financial benchmark from the call that anchors this entire bullish thesis.
The cash flow target.
Yes. Management noted that if revenue reaches mid to high single-digit growth for the full year, hitting a target of $8 in free cash flow per share is highly probable.
$8 in free cash flow per share is an exceptional metric. Free cash flow is the ultimate truth teller in financial analysis.
Because it's hard cash.
Right. You can massage EPS with discrete tax benefits, but you cannot fake free cash flow. It is the actual cash generated by the business after all the operating expenses are paid, and crucially, after the massive capital expenditures for the new fabs and the internal packaging facilities are fully funded.
So it is the capital that can be directly weaponized to benefit the shareholder.
Exactly. It funds the dividend growth, it funds the share buybacks that reduce the float and drive up the stock price, and it funds strategic M&A like the Silicon Labs acquisition without needing to take on crippling debt.
Right.
Generating $8 per share in free cash flow while simultaneously funding the construction of multi-billion-dollar domestic fabs, it is a testament to the sheer cash-generating power of their analog business.
It really is.
Yeah.
It feels like they are running a toll booth on the fundamental infrastructure of the modern economy. They spent the last 3 years investing their own capital to build extra lanes, internalize the staffing, and stockpile the tickets.
Great analogy.
Now they are just sitting in the booth. If the macroeconomic traffic shows up, the machine just prints cash.
The data absolutely backs that up. And there is a potential catalyst that could drive that free cash flow even higher.
Oh, what's that?
During the Q&A portion of the earnings call, analysts pressed management heavily on pricing dynamics. And management admitted that pricing across the board in Q1 was stable.
Which is impressive in itself, considering we are just coming out of an inventory digestion phase where companies usually have to slash prices to move volume.
Precisely. But they went further. They heavily hinted that if this massive demand surge, particularly in the industrial and data center segments, holds steady through the summer, the pricing power swings entirely back into Texas Instruments' favor.
Meaning they can charge more.
They could realistically begin implementing price increases in the second half of the year.
Because if you are a robotics manufacturer or an AI server architect who desperately needs tens of thousands of power management ICs to hit your Q4 production quotas, and TI is the only supplier with guaranteed internal packaging and 200 days of inventory ready to ship.
You're not going to argue.
Right. You are not going to haggle over a 5 or 10% price increase. You are going to pay the toll to secure the supply.
You pay the premium for reliability, which means that the highly probable target of $8 in free cash flow per share might actually be a conservative baseline. If pricing power expands alongside the margin leverage we already discussed, the cash generation in late 2026 and early 2027 could be historic.
This has been an incredibly dense analysis. Let's do a clear, actionable recap of the core takeaways from this massive data stack for you.
Sounds good. First, we have a commanding top-line revenue beat of 19%, and that was driven primarily by a 30% structural normalization in the industrial sector and a 90% explosion in data center revenue tied directly to AI power density requirements.
Second, we are looking at a masterclass in operational leverage. The massive capital deployed into 300mm wafer fabs is now absorbing fixed costs, driving a 210 basis point gross margin expansion and a 37% surge in operating profit.
Third, they are actively utilizing a $4.7 billion inventory stockpile, not as a liability, but as a strategic moat to guarantee lead times, all while simultaneously integrating Silicon Labs' wireless IP to dominate the next generation of industrial edge computing.
And finally, by aggressively internalizing their back-end assembly and testing, they have built a supply chain shock absorber that provides a highly probable path to $8 in free cash flow per share, with significant upside if pricing power returns in the second half of the year.
It is a fundamentally robust blueprint for capital return.
It really is. Which leaves us with a final, broader thought for you to consider. We began this deep dive by acknowledging that Texas Instruments is the ultimate bellwether.
Right.
Their highly standardized general-purpose analog chips are the foundational building blocks for everything from advanced AI server racks and factory robotics to basic automotive systems and grid infrastructure.
They are everywhere.
So if Texas Instruments' massive, diverse base of industrial customers is definitively waking up from hibernation, clearing their excess inventory, and returning to the market with 30% volume spikes across all geographies,
Then what?
Is this specific earnings call the definitive, undeniable signal that the global manufacturing recession of the past 2 years is officially over?
It is the ultimate leading indicator. When the foundational layer of the physical economy accelerates this aggressively, the broader macroeconomic recovery is rarely far behind.
Thank you for joining us on this deep dive. We encourage you to take these insights, evaluate the underlying mechanics of your own holdings, and use the structural perspective to navigate the market smartly. Until next time.